Hello, this Chartprofit video, Friday 18th of December. We're over 3 hours into the trading day. As you know, last week, we're looking here at the pre-open, looking at the E-mini S&P. Last week we had plenty of selling here, that's the red, and a pretty weak week. Probed that low on Monday down here, rallied back, and then we had the big event day on Wednesday with the market finishing on a high of that session. We did mark aggressive buying. I had no confirmation from the breadth numbers or the momentum, but we did have this following day, yesterday, Thursday. We just tested that green at top high, and then immediately that was rejected, and we closed really weak yesterday below 2043, which we've had as minor support, minor half range level this week. But we finished below that on Thursday in a weaker price location, so not much to recommend the market apart from just that little selling short-term positive indication which didn't follow through. We still need to see the breadth numbers improve, as I mentioned, and the momentum. Through yesterday's close, through Thursday, the breadth analysis looked like this. We've said these two indicators at the bottom here, this one, the net new highs 25 indicator, and the percentage of stocks greater than their 50-day moving average, still really struggling below their levels here and here, which keeps this red bar in the middle here, the breadth indication on the pulse chart, negative or red from early December. And we've now seen this week actually momentum, or the price oscillator, heading down into negative territory and heading lower. As we know, the level up here on the spider 209.90 is the major time resistance, and we've been unable to overcome that. Currently, if we look at the current chart here, the daily chart for the spider, we're down here, not a good end to the week. There's support down here at the half range. Levels will be in the ebook on Monday. Very little sign so far of decent end of year rally. Two of the big problems, overhanging problems for the market, price of commodities. Here I'm looking at crude futures, daily chart. Once again in December we've hit a new low, and we're really weak here at the end of this week again. And it looks like we're set to test 2008's low back over here on this continuation futures contract. And also we look here at the ETF for high yield. This is JNK, and we're here at the moment on this daily chart. This chart causing concern. There's a real weakness here, and this is the iShares chart, HYG, similar looking chart for high yield. We'll look at the sentiment indicators. This is the RIDEX ratio. So prior to the big event day on Wednesday, the RIDEX traders have been reluctant to commit. My version of the RIDEX assets ratio was actually lower on Thursday to 6.77. That actually doesn't tell us too much, but the 32-day low for that ratio is at 6.62, and that's here. As you know, we were much lower in September, October, but with the sell-off today, we'll possibly see this down, maybe a 35-40-day low for this indicator. I think one of the problems that we talked about recently for the market, if I just look here at the bull fund assets in isolation, as I pointed out before, this area up here was the extreme high level for the bull fund assets that we reached back at the end of last year. And just here at the end of November this year, we've seen the assets up into that kind of area again, showing really extremely high bullish sentiment readings from the RIDEX traders. It came off quite sharply here. That's why the ratio got so high here relative to itself over the last 3 months. And this point late November, before the market sold off again, RIDEX retail traders were getting extremely optimistic. So let's look elsewhere at the sentiment. This is the public poll from AAII, and this shows an increase in bearish sentiment this week. The bullish percent was lower, 23.9. Bears percent was higher, 39.4. That's quite a jump from the previous week's 29.9%. And 39.5, that's the highest bears percent in 11 weeks. And if we look at the net, the bulls minus the bears up minus 15.5. That's that single little red histogram over there. That's the lowest since week ending 7th of August. The exposure index, which measures current equity exposure of active money managers, that index was lower at 61.32. 3 weeks ago the index reached 70.45. That was the highest since June. That's probably more important. The fact it's a little bit lower this week. But the data from Lipper US fund flows is interesting this week. They reported equity fund including ETF outflows of 13.2 billion. That's a single week outflow to the week of 16th of December. So that was through the big event day on Wednesday. Looks like retail traders taking money off the table prior to the big event day. Nevertheless, that's the largest weekly net outflow since the 18th of September. And if we look at the 4-week flow, that is a net outflow of 19.82 billion. That's the lowest since that same date, since the 18th of September. And when we see the 4-week flow dipping below that red line there where it currently is, it's usually indicative of oversold conditions. So I find this one quite an interesting indicator this week. If we look at the current spider chart again, just possibly today's sell-off and possibly follow through to the downside on Monday, you might get a panicky kind of washout low in the spider. This is the important level to watch though for support on this chart, just above 198. Price lower than this here, or price printing time below that half range would be a real concern technically. Just generally another kind of long-term problem for the market is the fact that the S&P chart, the large caps, looking much healthier than the small caps. This is the Russell 2000. We've been watching this level here, the major point of control at 115.35 as resistance this week. If you look at the pre-open each day, we didn't challenge that level. In fact, the Russell 2000 ETF is going to end up most likely this week below the half range off the September low, which is the next level down of resistance. So this is really weak price location. So from this low to this high, once that high was put in and we had the sell-off, we were looking for support either at the major point of control or at the half range. That half range has now been broken, so this is really weak. And as I mentioned, just the fact the small caps are really underperforming the large caps over time, just another negative. European markets are closed. Looking here at the FTSE 100, the UK FTSE 100. Again, this was the obvious resistance at this halfway point off the previous high back in April. Had 4 attempts at it now. Said last week that that was exact resistance. That was really disappointing that FTSE hadn't managed to print some time above that level. One of the weakest charts we're looking at sort of globally. Broke back below its 8-month here and actually printed all the way back down to test its major point of control down here, which is this red line at 58.70 that's supported back here. In the panicky August low, it did intraday test that, but we had a close here earlier in the month, which was the weakest for I think 3 years. It rallied back to the obvious resistance here, which is the half range from this low to this high, and we've closed the week below there. So again, a really weak looking chart. And the German DAX has disappointed as well. We had some reasonable levels here that we thought may provide support once we got above those levels in November in a strong price location here, and this dip, we are hoping for this kind of support and bounce. We didn't see it. What we've seen is a decline below that and then a kind of bounce back to the resistance. So again, we finished the week here pretty weak. Nickel will be an interesting chart next week. This half range will be in play. That's the half range off the July high to the September low. If the Nikkei starts printing time below that level, it's yet another global index in weak price location. Looking here at bonds, this is the T-bond ETF TLT. This 12-month point of control at 121.40 here has just this week migrated up to 121.76, which is very, very close to the half range from the June low. So it's a bit of a bell curve going on here between that low and that high. And for a directional move, it's, as you know, seen many times, there's usually a migration of one of these points of control just before that happens. So just interested to watch this chart next week with doubly strong support around 121.76. And if the T-bond ETF can hold above that level and print some time up here, then look a lot more bullish than it did back in November. Momentum is positive and possibly turning back up here. And this is the 7 to 10 year ETF IEF, and these two levels we've been watching for a while now. 105 is the major here, and 106.60 is the 18-month, and we've been ranging, apart from these two probes here, between those two levels, and I suggested that breakout above or below these levels, looks more like it's going to be above at the moment, probably signal the next directional move now. So previously, looking here at the GLD, the gold shares ETF, that price below that July low would be really weak price location, and that's where GLD is still printing at the moment. Makes sense to look at the dollar index. This probe up here above the March high was rejected. Big sell-off. It's now attempting to recover. Reasonable end to this week. But if you're bullish on the dollar going into next week, you certainly want to see it hold above this minor level here at 98.85, which is the minor half range of this high, this recent high. Euro FX chart, important low back here in March to the subsequent high. Halfway point comes in here. Did support at this point. This was a weak position to consolidate. We saw the dip down here, then the rally back, which has now faded. I want to see price minimum printing above that halfway point up here. There's still plenty of overhead resistance here. We have the 12-month point of control here and the major half range level that we've talked about before just below it. So this sort of area here would be significant resistance, but price up here again, I mean, consolidation, not this kind of thing, spiky activity. In the long term, we've put the chart in a much stronger position. Currently we're a long way from doing that, so this is still really weak price location, which is indicator of strength for the dollar, as is the pound dollar chart as well. We're hitting multi-month lows at the end of this week, having probed up towards the half range point here from the April low, the important April low, to here. We probed up towards it and failed that test, so again no negatives here for the dollar. And in the Aussie dollar, keep watching this half range off the September low, and for whatever reason, even though we have major resistance above here, this major point of control at spot 76 and the major half range, down here this is looking like possibly a basing pattern for this chart. Even with the weakness in gold, this chart, for whatever reason, just to my kind of view of the chart, seems to be just relatively holding up. I just view this half range level here as better, as important level to watch. We've seen consolidation above it here. Price down here would immediately suggest weakness and a retest of this low, but just get a feeling that currently it's holding up. So let's see some strength in here, see if this minor pattern of higher lows can continue. Okay, just a one chart recap here. This is the spider, definitely relatively one of the best, strongest charts over the last few months, with many other global indices and sectors looking really weak. We should use this one and its levels. It has failed up here at its point of control. Apart from these probes, we were hoping to see this kind of price consolidation above that big level, but we've really failed there. I'm now hoping, especially looking at the sentiment indicators, just thinking the possibility that a further dip down next week could bring out some real bears and maybe give the contrarians something to look at. But this important level here at the half range, we'd be looking for support there if the market did test this week's low. But price, importantly, underneath this level would be a really poor indication for the spider and really equity markets generally. Okay, that concludes. Once again, I wish you a good weekend and thank you for watching.